My name is Simon Barnard. I'm the Portfolio Manager for the Smithson Investment Trust. I've been an investor for over 20 years, initially at Goldman Sachs, and then I joined Fundsmith in 2017. The fund objectives are to compound returns on invested capital, and we do this with a simple three-step strategy. Number one, we only buy very high quality companies, and by that I mean companies with high returns on invested capital and strong free cash flow. We also look for growing companies. Number two, we try not to overpay for these companies, and that's very important because even the best companies in the world, if you pay the wrong price for them, they won't be a good investment. And finally, we try to hold on to these companies for the long term, so that once we've got a hold of these great companies at attractive prices, we allow them to compound in value over time. The process starts by trying to find the best companies in the world that are within our market cap range. And for the Smithson Investment Trust, that's a size range of between £500 million and £15 billion sterling. And then we go about this in several ways. Primarily because we've got almost 10,000 companies available to us to look at, we start by using financial screens of the metrics of high quality companies. But to be honest, increasingly we are looking for companies in certain growth areas. And that could be anything from electrification of transport and industry, or the suppliers to space and aerospace companies, or even more recently, those companies supplying AI and data center construction technology. But it's been increasingly difficult to actually find those at attractive valuations, so it is not an easy space to invest in. Now, once we've found companies that are interesting to us, we do a deep dive in terms of research, and we write research reports, full financial models. We try to meet the management. And then we put them into our long list of around 90 to 100 companies that we have deemed to be high quality enough for us one day to invest in. Then we continue following those companies, and if they ever become the right valuation for us, then we buy them in the portfolio. Well, there are many exciting opportunities currently in small cap, but two that we've actually bought into the portfolio include first, Monotaro. This is a company based in Japan, which is a distributor of products to companies for everything that they need except their raw materials. It's called a maintenance and repair organization. So they distribute items, everything from rubber gloves to tools to office furniture to the technology needed to run the office. Now, what's important here is that they are an online retailer of these items, and Japan has still got a lot of progress to go in terms of moving this market online. In fact, it is only 20% online at the moment. But because Monotaro is the largest player in this market, that all of the growth that is accruing goes to Monotaro because they've got the strongest presence online and they've also got the broadest product range, which means that it's much more likely that a customer searching for items can get everything in one place with Monotaro. I think the second area that's very exciting that we've just bought into is research organizations for small biotech and pharma companies. Now, the company that we've bought is based in the US and it's called MedPace. And this serves only biotech and small pharmaceutical companies. And that again is important because this is by far the fastest growing area of the pharmaceutical research and development market. And what MedPace do is they offer all of the R&D activities that small biotech companies need. And this is required because these small companies just don't have any internal resources, not only to do the R&D itself, but also to run trials for their products. And so because MedPace can offer them a full contract that provides all of the services they need, they can offer a very high margin contract, which makes MedPace not only the fastest growing contract research organization in the market, having grown at over 20% a year over the last few years, but also the most profitable in the market. Well, up until 2022, we were trading at about a 2 or 3% premium, but since then, the trust has slipped to a discount to NAV. Currently, it is around 12%, but the board are very focused on this issue, and they've been buying back shares over the last 2.5 years. In fact, they've now bought back over 25% of the trust.